Hey, you've probably seen the headlines about Elon Musk's new 96 million share award from Tesla. A lot of people are looking at this and making a pretty costly mistake. They're either cheering it like their cats are breakdancing, or they're calling it outrageous corporate greed. But both of those reactions are driven by emotion, and emotion is what gets your portfolio shredded. The correct way to look at this is as a data point. It's a signal. And today, we're going to decode what that signal is actually telling you about Tesla's stock price. Not based on hype, but on cold hard numbers and strategic analysis. Look, if you're short on time, here is the single most important takeaway. Tesla's stock is at a critical pivot point right now. The entire rally that came from this news hinges on one thing: whether the price can stay above the current support level. If it drops below that, the whole bullish story pretty much falls apart. We're going to break down exactly why that number is so important. And for those of you who are new to the channel, my name's not really DataCat. I used to be an analyst. Let's just say I spent way too much of my life staring at spreadsheets inside a very large, very shiny corporate building. I traded that in for this setup, where I now stare at different kinds of data for you. And for my cat, of course. He's the real CEO around here. If that's the kind of no-nonsense analysis you're looking for, maybe consider subscribing. I'm trying to build a small community here that's focused on data, not drama. It would honestly mean a lot. Alright, so let's set the stage, because this didn't just happen in a vacuum. This whole saga really started with a massive $56 billion pay package for Musk. Now that package was approved by shareholders. Not once, but twice. But then a court in Delaware stepped in and essentially voided the whole thing. It's like when you try to give your cat a high-quality, expensive treat, but the other cat, the one with a law degree, just slaps it out of your hand for procedural reasons. So the Tesla board had to go back to the drawing board. What they came up with is this new award, 96 million restricted shares. Now, you have to ask, why this specific move? This isn't just about keeping Elon happy so he doesn't take his ball and go home. This is Tesla sending a very clear message to the market that it's evolving. They are signaling that they're all in on becoming a leader in artificial intelligence, in robotics with that Optimus project, and of course in self-driving technology. This award is structured to lock Musk in, to make sure the guy with the vision actually sticks around to see it through. This directly affects the company's long-term projects and, by extension, your retirement timeline if you're a long-term holder. There are serious strings attached. He's required to remain in a senior role for at least 2 years, and he has to hold these new shares for 5 years. It's basically the corporate equivalent of catnip, designed to keep his focus squarely on Tesla and not get too distracted by his other shiny toys like SpaceX or X. So, what happened the moment this news dropped? The market, for its part, seemed to let out a collective sigh of relief. The stock jumped over 2% on August 4th. The reason is simple: uncertainty is poison for a stock price. For months, this question mark about leadership and compensation was hanging over the stock. Wall Street hates uncertainty. This new deal, whatever your personal opinion of it, removed that question mark. And we saw that reflected in the trading volume. It spiked. Everyone from the big institutional funds to individual retail traders was jumping into reposition. It was like dropping a laser-pointer dot in a room full of traders. Now the big players, the ones who really move markets, they seem to like it. Prominent analysts like Dan Ives from Wedbush said this was critical to removing an overhang from the stock. What Wall Street doesn't want retail investors to know is that sometimes these massive pay packages are seen as a necessary cost to guarantee stability. For institutional investors, the huge funds that own big chunks of Tesla, knowing the CEO is legally and financially tied to the company for the next few years is a massive risk mitigator. It aligns his incentives with theirs, make the company grow long term. Now if you go on social media platforms like X, it's a different story. The sentiment there is much more mixed. You have the die-hard supporters, and then you have people who are very concerned about dilution. And that's a completely valid concern. Let me explain. When a company issues millions of new shares, each existing share you own now represents a slightly smaller piece of the total company. Imagine you have a pizza and someone just decides to add more slices to it without actually making the pizza bigger. Your slice is now smaller. That's dilution in a nutshell. Alright, so looking forward, what does this all mean for the stock? Well, in the short term, the stock is projected to benefit from this immediate reduction in leadership uncertainty. That's given investor sentiment a nice boost. But it's not all smooth sailing from here. There are two pretty significant risk factors you need to keep on your radar. The first one is the potential for renewed legal challenges. Remember that Delaware court that rejected the first package? Well, this new award could face its own set of legal battles. If a future court ruling deems this new award structure unsatisfactory, all that uncertainty we just got rid of comes roaring back, and the market will not like that one bit. The second risk is that specter of share dilution. When a company issues 96 million new shares, as we discussed, it can exert downward pressure on the stock price over the longer term. The only way to offset that is through robust company performance, or if Tesla initiates share buyback programs to reduce the number of shares outstanding. So, what should you be doing? You need to be watching this closely. Monitor any legal developments around this award, and on the quantitative side, you should be watching indicators like changes in options activity and shifts in short interest. That's the amount of money betting against the stock. These can give you clues about what the big players are thinking. And from a pure risk management perspective, in an environment with this much market volatility, it's critical to consider diversifying your exposure and maintaining balanced positions. Don't put all your catnip in one bowl. Okay, let's get to the charts. This is where we move past the story and into the tactical analysis. The fundamental news about Elon's compensation has created this surge, and the chart lays out the current situation with precision. We can see exactly what levels define success or failure for this move. First, we have the profit-taking zone, which is the resistance level at around 315-320s. This remains the key ceiling. It's the level where the last rally ran out of steam and failed. A break above this would be exceptionally bullish, signaling a new leg up for the stock. But the most important level on the chart right now is the floor, the bullish foundation. This is the immediate support at approximately $285. This was the consolidation area back in July, where buyers built a strong base before the recent breakout. It's critical because for the current bullish momentum to continue, the price must hold above this $285 level. A drop below this support would not just be a minor pullback, it would signal that the entire rally fueled by the compensation news has failed. If we look at momentum, the RSI is currently in the neutral zone. After that recent price jump, it's likely moving up towards the 60-70 range, which would show strengthening momentum. And this brings us to the decisive battle happening right now. The price is currently fighting to get above and stay above the 200-day simple moving average. This is the most immediate and important technical battle. Institutional investors heavily watch the 200-day SMA. A decisive move above it often triggers their algorithmic buying programs and signals to large funds that the long-term trend is turning positive. And in fact, the stock is on a pivot point right now. The 50-day moving average is touching closely with the 200-day moving average again. If it breaks below the 200-day MA, that forms a pattern known as a death cross, which will pose an immediate bearish signal to most traders. It's like my cat seeing a cucumber on the floor, just pure immediate panic. So to put it all together, here is the definitive playbook. This refined view provides a clear, actionable set of scenarios for you. Here is the bullish thesis. The confirmation you're looking for is the stock successfully holding above the 200-day SMA for a few days and using that $285 support level as a solid floor. Any pullbacks should find buyers in this zone. If that happens, the primary objective is a test of the $350 resistance. The next major target after that would then be the key resistance level at $357. The investor takeaway is this: as long as buyers enter aggressively whenever the price drops to $285 momentarily and allow it to bounce back, the path of least resistance is upwards. The bullish catalyst is still in play, and here is the bearish warning signal. The confirmation here would be the stock failing to hold the 200-day SMA, and more importantly, breaking and closing below the immediate support at $285. This would be a significant red flag. It would indicate that the positive news was not enough to sustain momentum and that sellers have regained control. And the next stop, a break of $285, would likely lead to a swift move down to test the next major support level from April, which is all the way down around $246.50. The market has given you the key levels to watch. Now you know exactly what to look for. Hey, if you made it this far, thank you. I really do appreciate you spending your time here. If this breakdown was helpful, a like on the video would be awesome, and if you haven't already, hit that subscribe button to join our little community. I'll be back next week with another deep dive. Until then, stay sharp. DataCat out.